Thanks for coming. Today we have a panel, a seminar on the subject of XVA. The title is The World After the XVA Implementation Projects. So I'll get the panel to introduce themselves. I think, the subject is I think, probably familiar to many of you now. I think there's been a lot of discussion about CVA, DVA, FVA, KVA, a new XVA every couple of months. So I think it's a subject that should be familiar, but it's also a subject where I think still there's not a lot of right answers. So there's still a lot of stuff to be sorted out, and I think it's very fortunate to have such a experienced panel here. I think all of the people here are pretty much doing this day to day, which is not such a common thing to get that group of people together. So it's definitely a good opportunity to ask the tough questions. Just to sort of a start, in terms of, well, maybe I'll start with an introduction. So I'm Rowan Douglas. I'm CEO of Quantifi, co-sponsoring this event with Deloitte. So maybe I'll ask the panel to introduce themselves, starting with Mario.
Thanks, Rowan. My name is Marius Lehner. I'm director at Deloitte, responsible for the XVA initiative in the German-speaking countries, and dealing with XVA since the last 7.5-8 years.
Okay. This way? Yeah. My name is Dirk Talkenberger, Decker Bank. It says DZ Bank, but that's an error. It's not not an unannounced change. I'm heading a department called Bewertung Finanzprodukte. I haven't found out what the English name is because we changed the organization only on the 1st of April. And then it covers, apart from the actual valuation of all trading and banking book positions, all the counterparty stuff as well. So starting from XVAs, potential future exposure, initial margin calculations, everything which is somehow linked to counterparty risk.
Okay, my name is Birgitta Drewensky and I work for Commerzbank. There are lots of former colleagues and present colleagues here. So I started my working life as an interest rate option trader a long time ago, then moved into credit derivatives, and then CVA trading and management at the time was kind of the natural extension. I now work in a department that's called, and also struggle with the name because they constantly change, Risk and Resource Management, and it's called now Risk Management and Resource Optimization. I've got a pricing team to calculate these risk implied costs in derivatives prices.
Hi everybody, Rainer Overbeck from DZ Bank. I work on credit derivatives for 15 years, let's say, roundabout, and I'm heading the structured credit department, which is still alive at DZ. It changed, but it's live. And 2 years ago, I took over an additional mandate to have a kind of front office CVA management function, and that's why I'm here.
Hi, my name is Jeremy Weiss. I run the CVA trading desk at UniCredit. To continue with the theme, I also have a structured credit background. I think that's not uncommon in the XVA space. I've been at UniCredit for 5 years, basically building the XVA desk there. In terms of what we do and how we do it, we're a front office, basically trading desk. We're responsible for the pricing and mitigation of the XVAs, let's call it. In terms of what we look at CVA, we look at DVA, look at funding, look at capital hurdles, look at IM charging as well. Yeah.
Okay, thanks. So the basic idea tonight is to pose a number of questions to the panel and sort of have discussions around particular topics. Feel free to raise your hand if there's anything that's not clear or if you want to inject a question. At the end, we'll have a 15 minutes of Q&A specifically. So maybe to start out with, to get a sense of within the audience how many people work for banks. That's an easy question. Well, maybe. Okay, a lot. How many people work for banks that calculate CVA? Okay. How many work for banks that calculate FVA? Okay. Less. What else can I ask? Yeah, so I guess that's a good starting point. If I asked some of those questions even a couple of years ago, it would have been a mixed response. So maybe I'll start by posing a very general question to sort of get the lay of the land, so to speak. So maybe to the panel in sequence, just a comment about what do you think are the most significant impacts of XVA on the OTC market? So pretty broad subject, but maybe starting with you, Jeremy, in reverse.
Sure. Yeah. I mean, certainly, we've seen since the financial crisis and the widespread use of XVA. I mean, the impact on mainly two areas that we focus a lot of time on, and that's the pricing of derivative transactions and the volatility resulting from those transactions. So it's understanding the accounting implications, the regulatory capital implications, both in terms of the underlying charges, but also in terms of any mitigation you might do on the back of those charges. And it's basically trying to do that in a framework. I sometimes think about it, it's kind of like doing open heart surgery on a marathon runner, right? Because I mean these businesses are still continuing, they're still doing trading with clients, and it's been over the course of the last 5 years, basically incrementally bringing these concepts and these principles into a trading environment. So yeah, I mean, it certainly changed the way management thinks about the business, the KPIs that the business drives. It's not a risk-free business, it's risky. There's a cost to that risk. There are hurdles that you should put on that risk. Yeah, I could go on and on, but I'll stop there, I suppose.
For us, definitely, most impact came from CVA. Of course, everything on this XVA debate starts with CVA. And of course, CVA risk is not new. It has been there 10 years ago. It was not named like that, but credit risk and derivatives has always been there. And was, of course, part of the front office pricing. What changes was the IFRS demanded accounting. You have to build a reserve for that. That's definitely a new one. And what changed was the impact of Basel III, additional CVA capital risk charge. And I think that was the starting point for DZ to go closer into this CVA topic. Yeah? And that's why we set up our function, which is not a trading desk like Jeremy is running, is more is kind of a gatekeeping function. We try to sort out the deals we would like to take on the book and avoid the deals which we think could be disclosed as a mispricing ex post. Yeah. But it starts definitely with CVA and the regulatory and the accounting change of treatment.
Sorry. So, as Rainer has said, XVA, or the costs associated with the resources used in derivatives, are nothing new. Capital was used in the past, funding was used, but either the trading desks weren't debited with these costs, or nobody associated with the derivatives was really involved in calculating these costs. And that changed first with CVA, then capital came into place, and funding costs. We also have these, we spoke about it earlier, the costs associated with collateral posting, and the way which collateral instrument is actually used in a derivative contract. All of this has an impact on the price and the kind of value added a derivative has. And this is what has changed in the past. In the past, the trader looked at market parameters, gave the price to the salesperson, and they either negotiated a margin or didn't, and in the end, people were happy or not happy. Nowadays, the salesperson, and the life of a salesperson, I think, has become a lot more difficult. They not only need to check limits, they need to talk to the CVA desk about CVA charges, they need to consider capital cost, they need to have a look at now the implied or leverage ratio implied capital cost. So the regulation isn't over. Every new piece of regulation offers a new facet onto a trade or onto a trade relationship. And one of the fundamental changes I think this new XVA pricing has introduced is that it offers different views onto the same trading portfolio. Under RWA optimization considerations, certain trades and counterparts look absolutely fine for the time being. Under leverage ratio considerations, they don't. So how does a bank want to steer their business? Do they want to look at trades? Do they want to look at relationships? And this is what banks had to change or have to change the way they look at relationships and look at their trades.
Okay. Switching to the risk side, sort of. What we said before, it's nothing new. My former employee was called lesser rated counterparty reserve, but it was essentially a CVA charge for sub-investment grade counterparties. So that was already in the early 2000s, so this is really a long story. From risk perspective, what has changed by the financial crisis and the CVA was more or less coming up at the same time, although probably slightly before that. So I think most of the people would attach that the appearance of CVI in a broader range to the financial crisis, 2007, 8, 9. It has made the world a lot more complicated. So from every simple product, be a forward rate agreement, simple plain vanilla swap, has turned into a path-dependent complex option. You need a lot of server capacity and memory in your servers to actually calculate the figures. It's not ab initio clear how to redistribute the figures back to single trading desks. There's a lot of decisions to be made. So that all on top of at the same time, another topic, multi-curve setup. So it made the valuation of a whole portfolio really complicated. And especially if you're in a risk department, then you're usually always a bit behind the trading desks. It's on the one side, you're trying to catch up with the trading desk. On the other side, as Birgitta mentioned, there's a lot of regulatory requirements which were coming in over the last years. And that's, at least with my bank, something which the traders expect that we actually bring that to the traders and explain them how that works. And so it's probably different at DZ Commerzbank or UniCredit. But I always have the impression that at DECA we have to push the traders to actually implement the stuff and adopt to that. So it's a bit upside down probably. But in the essence, I think from risk perspective, it has made the world much more complicated, much more complex with respect to daily calculations. A lot of areas which were quite apart in former times are now closely connected. Credit trading, interest rate derivatives, RWA optimizations. I think this is the main impact that a lot of areas in the bank which were only loosely connected now have to work closely together to get to the optimal setup.
Adding to to all the things that I already mentioned, I think one of the observations that I have made and in my discussions was more what is new in the OTC market itself. I think is more how the risk is managed and how we look at this risk from now. And I think in looking back in the old trading days, I think everybody did know there's a counterparty credit risk involved in any trade, right? Has it been expressed as a certain measure. No, not up to now. It was in a margin, which I would now stress the argument and would the hypothesis saying, comparing trades and margins back then with now the CVA measure, I think there's not much difference, that traders who really did know their counterparts did price the risk in it. On the other hand, I think one of the major things that I've seen, I think this is one of the major problems right now, is the increased P&L volatility in a product which is not that complicated compared to 5-10 years ago, right? Through this effect of CVA and calculating CVA and DVA and call it KVA, LVA, we probably touched that today as well. But I think this is one of the major problems from my perspective, seeing and looking at the businesses. You need to deal now with different problems in your daily business, and even planning business in the trading area is complicated anymore because you cannot quantify that so dramatically specific. And I think this is one of the major problems right now for the banks itself. And one of the other things, coming back to the increased complexity in the modeling, obviously that means the model risk increased. And how do you deal with that again? So it doesn't help you just looking at from the one side, now we can calculate and measure it, but what do we do with the risk which we end up at the back end saying, what is the influence on our model risk framework on that?
Right, okay, thanks.